So imagine waking up one morning, you grab your coffee, and you realize you are suddenly responsible for borrowing literally hundreds of trillions of rupiah before the end of the year.
Right. Just to keep an entire country's economy moving.
Exactly. The pressure is already immense, right?
Yeah.
But then you look at the screens on your desk. Global markets are panicking. Capital is just fleeing your region, and local banks are practically hoarding their cash.
It's a nightmare scenario. You are entirely on the clock.
You really are. So today, we're taking you inside the nerve center of Indonesia's 2026 state budget, the APBN. We want to look at exactly how a modern economy keeps the lights on when the financial weather turns, frankly, incredibly hostile.
Yeah, and we're zeroing in on a highly specific tactical maneuver today, a 32 trillion rupiah debt auction.
Right. And to do this, we are pulling from a massive stack of recent government fiscal reports, deep economic analyses, and a ton of financial news excerpts.
And what you quickly realize when you're going through all these sources is that the narratives are completely polarized. I mean, they are night and day.
Oh, for sure. You've got government ministries putting out data, insisting on, total fiscal resilience and absolute stability.
Well, simultaneously, you have these independent think tanks practically ringing the fire alarm over impending debt crisis.
Yeah, so our mission in this deep dive isn't to pick a side between those two extremes. We are staying completely neutral. We just want to look at the raw data they are both staring at and, decode the actual mechanics of what is happening behind the headlines.
Because if you live, work, or invest anywhere in this economic ecosystem, this isn't just about government spreadsheets.
No, not at all.
It's essentially a real-time chess match. You have global geopolitics dictating capital flows.
Yeah.
You have domestic central banks weaponizing interest rates, and all of it trickles down into the everyday economy.
Right, like a shift in a bond yield in Jakarta directly impacts whether a local business can afford a loan to hire more people. Every single move has a massive ripple effect. Okay, let's unpack this. To understand why the government suddenly needs to auction off 32 trillion rupiah in debt right now, we first have to look at the sheer scale of the 2026 state budget.
The giant shopping cart, basically.
Right. Just looking at the macro numbers here, the gap between what the government plans to spend and what they actually expect to collect in taxes is, it's enormous. It's like a family realizing their annual expenses are drastically higher than their income, so they decide to issue IOUs to their wealthy neighbors to cover the difference.
Yeah, it is a truly vast shortfall. Based on the 2026 budget posture, total state spending is projected at roughly 3,842.7 trillion rupiah.
Wow.
Right. And on the other side of the ledger, their revenue target sits at about 3,152.6 trillion. So simple arithmetic leaves us with an initial baseline deficit of almost 690 trillion rupiah.
And from what I see in the finance ministry's projections, that number doesn't even stay put. Right?
No, it doesn't.
Because Finance Minister Pordaya Yudhisadewa projects that gap is actually going to widen as the year closes out.
Yes. The projection pushes the deficit to over 734 trillion rupiah.
Which is what, like 2.85% of GDP?
Exactly, 2.85%. And the mechanics behind that widening are mostly about timing. Government spending in Indonesia historically backloads into the second half of the year semester too.
Okay, so infrastructure projects finish up, they build the state, social programs accelerate their payouts, that kind of thing.
You got it. So to plug this massive structural hole, the government has set a target for net debt financing at roughly 832.21 trillion rupiah. And they are leaning incredibly heavily on domestic government securities, or SPN, to get it.
So if the ultimate goal is finding over 832 trillion rupiah to cover the year, how does this one specific 32 trillion auction fit into that? Are they just testing the waters?
If we connect this to the bigger picture, it is entirely about market psychology and supply mechanics. You cannot just walk into the financial markets and issue 800 trillion rupiah worth of bonds on a Tuesday.
Right, because the sudden oversupply would just completely crash the value of the bonds.
Exactly. It would drive the interest rates the government has to pay into the stratosphere. So this 32 trillion target, which is flexible, by the way, they have a maximum absorption limit of up to 150%.
Meaning they can take up to, what, 48 trillion if investors are hungry enough?
Right. It's a tactical pacing instrument. They break the borrowing down into periodic chunks to ensure they don't overwhelm the buyers.
Which brings up the next obvious question. What exactly are they selling to these buyers?
The auction menu.
Yeah. I was looking at the auction details from July 7th, 2026, run through Bank Indonesia's electronic multiple price system. And they didn't just offer a generic government IOU.
No, they offered 9 completely distinct series of bonds.
9. You have short-term notes, called SPN, maturing just a few months or by 2027. But then you have long-term state bonds, the on-end series, stretching all the way out to 2064.
Right.
I mean, it is wild to think about someone today buying a bond that matures 4 decades from now. Why offer such a wild variety of expiration dates? What's the strategy there?
Well, it sounds completely counterintuitive in a fast-moving market, but it really comes down to targeting different investor psychologies. It's a concept called liability matching.
Okay.
So the primary dealers participating in this auction are incredibly diverse. You have foreign banking giants like Citibank and JP Morgan.
Sure.
You have local state-owned heavyweights like Mandiri and BRI, plus private banks like BCA and Denom and various securities firms.
And they all have completely different agendas for their cash, obviously.
Precisely. Because, a commercial bank is basically obsessed with short-term liquidity.
Yeah.
They have customer deposits they need to be able to access relatively quickly.
Because they want to park their money in those short-term SPN notes.
Exactly. They make a solid risk-free return for a year, and then they get their cash back. But the banks aren't touching a bond that matures when their current analysts are in nursing homes.
Right. That 2064 bond is, who's that for? Pension funds.
Yes. Custom built for pension funds and life insurance companies. Think about the business model of a pension fund. They collect premiums today from a 25-year-old worker, and they legally guarantee a payout when that worker retires in 40 years.
So they're terrified of short-term volatility.
Terrified of it. They desperately need an asset that guarantees a stable yield for 4 decades so they can map out their exact ability to pay those future liabilities. A 2064 sovereign bond is exactly the anchor their portfolio requires.
Okay, that makes sense. But getting all these different institutions to actually hand over their cash requires an attractive interest rate.
Always.
And looking at the broader economic environment, getting people to buy Indonesian bonds right now seems incredibly difficult.
Yeah.
There is this massive global headwind forcing the government to pay a serious premium just to get investors to show up to this auction.
The global macro environment is basically acting like a giant vacuum, pulling capital away from emerging markets. The primary culprit is the U.S. Federal Reserve maintaining an aggressively hawkish stance, meaning they are keeping U.S. interest rates high.
Right. And you combine that with ongoing geopolitical tensions in the Middle East, which traditionally pushes investors toward safe haven assets.
Exactly. So if a global investor can get a high, virtually risk-free return by simply buying U.S. treasuries, they pull their capital out of a market like Indonesia.
That is the capital flight mechanism in a nutshell. And when global investors sell off their Indonesian assets to move their money to the U.S., they are selling rupiah to buy dollars.
Right. And that massive sell-off took a direct toll on the currency, weakening the rupiah down into the 17,709 to near 17,981 per U.S. dollar range.
Which means Bank Indonesia, the central bank, cannot just sit by and watch the currency plummet.
No, they have a mandate.
Right. To protect the rupiah and keep inflation from breaking their 2.5% target ceiling. So they had to step in. They stepped in hard. They hiked their benchmark interest rate, the BI rate, from 4.75% in April to 5.75% by mid-June 2026.
That is a massive 100 basis point jump in a short time.
Let me push back on that for a second, though. To someone outside of finance, a 1% increase over 2 months sounds like a rounding error. Doesn't that make the government's own borrowing incredibly expensive? I mean, is that really hitting the emergency brake on a highway?
It absolutely is. In central banking terms, a 100 basis point hike in basically 8 weeks is the equivalent of a physiological shock to the system. Central banks usually move in 0.25% increments to avoid spooking the markets.
Oh, wow.
Moving a full percent that fast shows a central bank that is prioritizing currency defense above almost everything else. And what's fascinating here is the brutal trade-off this creates for the broader government.
Because Bank Indonesia is an independent institution just doing its job to protect the currency.
Exactly. But by drastically raising that baseline rate to defend the rupiah, they inadvertently set the finance ministry's borrowing costs on fire.
Because if the baseline central bank rate is nearly 6%, the government has to offer an even higher yield on its bonds to convince anyone to buy them.
Right. To remain competitive and hit that 32 trillion rupiah target at auction, the government had to offer yields up to 7.125% on some of those longer tenor bonds to remain competitive.
Which is fantastic news if you are a pension fund buying the bond, but it is a terrifying bill for the state to pay.
Oh, absolutely terrifying.
And this is where the macroeconomic mechanics hit the real world, right?
Yeah.
That expensive borrowing cost doesn't just drain the state treasury, it fundamentally distorts the everyday banking system. Let's look at the sheer weight of this debt.
Let's do it.
The sources note that just to pay the interest, not the principal, literally just the interest on their accumulated debt in 2026, the government has to set aside nearly 599.44 trillion rupiah.
It's staggering.
That's consuming almost 20% of their total projected state revenue.
It creates a massive opportunity cost. That is almost 600 trillion rupiah that cannot be deployed for new infrastructure, upgrading healthcare facilities, or investing in the education system. And it gets much more precarious when you factor in the refinancing risk.
Right.
The data shows that over 833.96 trillion rupiah in old existing debt is maturing in 2026 that needs to be paid off.
Meaning the original IOUs have expired, and the government owes the principal back to the investors. But they don't have the cash to pay it off, so they have to issue new debt to pay off the old debt.
Exactly. And they are refinancing that old debt in today's high-interest environment, requiring even more borrowing. It's a compounding pressure. Plus, to mitigate currency risks, they are aggressively pulling back from foreign loans down nearly 69.39%.
Okay, so they're hunting for hundreds of trillions of rupiah exclusively within the domestic market.
Yes.
So think of the domestic financial system like a small bucket of water.
Okay, I like that visual.
Right. And the government, because they need all this cash to cover the deficit and refinance old debt, they step in as a giant sponge.
A very absorbent sponge.
Exactly. By soaking up all the local cash with these attractive safe bonds and SRBI, there's basically no water left in the bucket for local businesses who actually need loans to grow.
That phenomenon is called the crowding out effect, and it is one of the most dangerous side effects of sovereign debt reliance. If you are a risk manager at a local bank, your choice is simple. Do you lend 50 billion rupiah to a mid-sized logistics company facing fluctuating fuel costs?
Or do you take that same 50 billion, park it in a zero-risk government bond yielding 7%, and go play golf?
The rational institutional choice is the bond. But the consequence of that lack of financial intermediation is that banks stop acting as the engine for private sector growth. It could stall the very economic growth the expansive budget is trying to protect.
Wow. Hearing the scale of those interest payments and the very real threat of crowding out local businesses, it is completely understandable why there is public panic rising. We saw reports from think tanks like Firavstra, and they estimate that as total national debt approaches 10,000 trillion rupiah, the burden essentially equals 32 million rupiah for every single citizen.
Right. And you even have major rating agencies like S&P Global issuing warnings, noting that Indonesia's interest-to-revenue ratio is bumping against the absolute maximum tolerance limit of 15 to 20%.
Which is a big deal. And again, to you listening, we're not taking a side between the think tanks and the finance ministry here. We're just looking at the raw data.
Because a downgrade from S&P would immediately trigger another massive spike in borrowing costs.
But here's where it gets really interesting. Despite all these headwinds, the capital flight, the S&P warnings, the global pressures, the performance data from semester 1 of 2026 actually paints a very resilient picture.
It does.
The government managed to keep the mid-year deficit clamped down to just 196.5 trillion rupiah. That is only 0.7% of GDP. How are they keeping the deficit so small when the cost of servicing their debt is skyrocketing?
The data points to a massive structural win in revenue collection. They were heavily supported by a 22.1% to 23% year-over-year surge in tax revenue.
That's a huge jump.
It wasn't accidental. It was a result of aggressive systemic reforms within the Directorate General of Taxes, the DJP. They modernized compliance tracking and widened the tax base significantly.
It is a fascinating paradox, right? The debt burden is rising and becoming vastly more expensive. But the state has suddenly become so much more efficient at tax collection that it's unexpectedly bailing them out.
It shows remarkable control at the Treasury level. Keeping the mid-year deficit at 0.7% under these macroeconomic conditions is incredibly resilient. However, the S&P warning is a ticking clock they can't ignore. They know they cannot rely entirely on domestic banks forever without completely starving the economy.
Right.
That is why their stated defensive strategy for semester 2 involves a heavy push to expand their investor base outside the U.S. They are looking to attract international buyers to lower the average yields they have to pay.
Relieving that sponge-like pressure on domestic liquidity. Okay, so we've established they are fighting tooth and nail to secure this money. They are dodging global capital flight, absorbing massive interest costs to pull all this cash in. So what are they buying? What exactly is on the shopping list for the borrowed money?
The budget outlines massive funding for President Prabowo Subianto's 8 priority programs.
Right, which focus heavily on food security, national defense, and human capital.
But the absolute spotlight of the 2026 budget, the program drawing the most scrutiny, is the Free Nutritious Meal Program, or MBG, which is a nationwide initiative to combat child stunting.
Yeah, and I noticed a massive shift in the numbers for that specific program. Initially, the MBG was tagged with a jumbo allocation of 335 trillion rupiah. But the recent revisions show President Prabowo ordered that budget slashed down to 268 trillion for 2026, aiming for an eventual target of 174 trillion.
Right.
So what does this all mean? Usually when a government slashes a flagship program's budget by that much, people assume the program is being phased out.
That is the standard political assumption, yeah. But the sources indicate an aggressive pivot to efficiency here, because every single rupiah the government borrows right now costs them a massive premium in interest. They simply cannot afford bureaucratic waste.
So they didn't cancel it. They're relying on better governance by the newly formed National Nutrition Agency to force better management.
Exactly. The high interest rates actually acted as a disciplinary mechanism on government spending. And this raises an important question about their broader economic execution, because the MBG program isn't the only massive capital outlay.
Right. They also allocated 3.05 trillion rupiah for investments and the national energy transition, right?
Yeah.
Stuff like renewable infrastructure, solar, and hydropower.
Yes. Add to that another 90 trillion rupiah allocated directly for village capital expenditures, which is designed to decentralize growth and create rural economic hubs.
So they are trying to aggressively build green energy in rural hubs while managing this enormous high-interest debt load from the past.
And that is why the success of the 2026 budget hinges entirely on this newly enforced fiscal discipline. The ability to fund those green energy and rural hubs depends on it. The math behind this budget will collapse if they aren't efficient. The high borrowing costs leave exactly zero room for error.
Wow. When you step back and look at the entirety of the 2026 fiscal landscape, the sheer balancing act is staggering. Managing global shocks, protecting the rupiah, shifting to domestic debt, and funding massive social programs, all while walking a tightrope of interest payments.
It's a razor-thin tightrope.
It really is. And that 32 trillion rupiah debt auction we started with is just, the balancing pole helping them take the next step. We have waded through some incredibly dense financial mechanics today, and we really appreciate you taking this deep dive with us to understand how these massive gears actually turn.
Yeah, we spent a lot of time today analyzing the shift from foreign to domestic debt and how the government is acting as a sponge in the local banking sector. But I want to leave you with a final lingering thought based on that shift.
Oh, definitely. Go for it.
If the government successfully shifts its massive debt burden primarily onto domestic investors and local banks, consider this. What happens to the fabric of society when an entire generation's domestic wealth and retirement funds become completely dependent on the government's ability to continually tax that very same population to pay them back? Are we insulating ourselves from global shocks or just locking ourselves into a closed financial loop?
Man, that is a provocative thought. It completely reframes the concept of national debt. Keep an eye on the bond yields, watch how the central bank maneuvers, and most importantly, keep asking the hard questions about where the money is really flowing.